today we will be breaking down exactly how much somebody aged 60 with $900,000 saved can spend in retirement.
We're both certified financial planners, and every year at our company, we help hundreds of people understand how much they can spend precisely in retirement. The truth is, people out there are watching generalized advice that they find online. This is causing them not to tailor the advice to their specific situation.
But that's exactly what we will help you out with today. We will not only walk through how much somebody aged 60 with $900,000 in savings can spend in retirement, but we'll also walk through the thought process behind it, so you can apply the process to your own life. So with that being said, let's get into the video.
So today we're going to be taking a look into a financial planning situation for a sample client, someone that does have $900,000 and retiring at age 60. And in this case, we have Jane Sample here. And Carla, why don't you walk through a couple of the assumptions we have laid out for Jane?
Of course, John. Here we have the base inflation rate at 3%. So we'll have all expenses, all income at an inflation rate of 3%. We have Jane retiring at age 60. And life expectancy for Jane is at age 90. Jane has one principal residence worth $1 million, no debts, no mortgage. In terms of liquid assets, we have an RRSP with $600,000 in a diversified portfolio, 70% equities, 30% fixed income, with an expected return rate of just under 7%. Her TFSA is at $150,000. And a non-registered account at $150,000 with a cost of $100,000. Jane earned $100,000 pre-retirement. Jane is eligible for 100% of CPP, which she'll be taking at age 65. And Jane will be receiving OAS at age 65 as well. Jane has lived in the country all her life, so will be eligible for maximum old age security benefits.
So now that we laid out the assumptions there within the financial plan, it's time to start thinking about what would Jane really want to accomplish here in her retirement. And, you know, usually when we get some clients coming in, I'd say one of the bigger questions we have is, you know, when should I take Canada Pension Plan? Am I going to leave behind some assets to the next generation? You know, what are some key questions that maybe we should be able to answer for Jane in this financial plan?
Those are really important questions to ask, John. Every Canadian's retirement is going to be different. They're going to have different wants and different needs in their retirement. And that's exactly why you work with a financial planner. Because in order to accommodate your retirement needs, it's not a cookie cutter plan. Yeah. So we have to figure out what you want out of your retirement and determine, you know, questions like, where are we taking your income from? Do you need to be tax efficient? Is that going to provide you with that large estate that you're wanting to do? Or do you not have any dependents? Will you want to use up as much of your estate as possible? And saving tax at the end isn't important to you. This is why you work with a planner. And this is why we're going to walk through Jane's example of having $900,000 in retirement.
Yep. So let's take a look at what a cash flow is going to look like for Jane in this scenario. And we have it laid out starting in the year 2024 all the way up through the next 10 years. And if you notice there on the left-hand side, there's going to be different forms of cash inflows going to be coming her way in the form of Canada Pension Plan, old age security. But if you notice here, at the age of 60, we have deferred Canada Pension Plan and old age security out to age 65. So that's where it would begin. To get us started, we'll start taking $4,000 a month from the RSP, or about $48,000 total. There'll be additional non-registered liquidations that can come from the account of about $12,000 for this year. There's going to be a bit of investment income that's going to be accrued, and some of that is going to be on that open account or non-registered funds. This all gets reinvested back in later on. Total cash inflows for Jane will be about $63,147. Now, with this assumption of income, we have Jane being able to spend $48,000 a year in terms of lifestyle expenses. Now, that's just general day-to-day living, about $4,000 a month. And then in addition to that, we have a vacation expense of about $5,000 per year. So a total of about $53,000 in a given year. There are some other miscellaneous expenses there. We have Jane doing some charitable donations of about $500 per year as well. And then we take a look at the tax bill, about $8,000 per year in terms of taxes that Jane would have to be paying. Now that stays pretty consistent over the course of the next couple of years, at least for 2024 and 2025. The only slight difference in 2026, we have assumed vehicle purchase for Jane $30,000 in today's dollars. So that is going to increase expenses, and we have that reoccurring every 10 years. I'm sure, as you already know, we'd be happy if we get our car to last 10 years. So we have that broken down in here for Jane as well. The next big break that we'll see is in the year 2029. So that's the period of time where Canada Pension is going to begin to kick in. So you'll get an extra $28,000 of income from Canada Pension Plan as well as Old Age Security. And then again, that is indexed with inflation, so that'll be increasing over time. The RSP, we're still continually taking our $4,000 a month. But if you notice here, the non-registered redemptions have stopped. So no longer are we going to have to take from the open account. We have a sufficient cash flow coming from Canada Pension as well as from the RSP withdrawals. Total cash inflows now are up to $77,585. Expenses are at $61,442. Continually increasing with the rate of inflation as we have originally discussed. With the increase in income, that means an increase in taxation. So Canada Pension, Old Age Security, as well as the RSPs are all going to be taxable. So we see a jump from $8,000 approximately in tax paying to about $12,500 in the year of 2029. That does leave Jane with a slight surplus, about $1,500 per year, and that's money that as we know, expenses come out of the blue, might be money that's spent elsewhere or rolled into a savings account, creating an emergency fund. If Jane continues to stay on this track going forward, she consistently stays at either a cash surplus or a complete break-even going forward.
Thanks, John. Yeah, it's really important for us to determine cash flow and ensure that our clients can be living without a cash flow deficit. In this case, there was no cash flow deficit to age 90, which was life expectancy. But let's see what was left over in terms of net worth. Age 90 for Jane was 2054, and she was leaving behind a net worth of $3,300,000. And the bulk of that was in her principal residence, which started in 2024 at $1 million, but with growth ended up being $2.4 million, and she still had $870,000 left in her TFSA. So an estate to be left behind to her beneficiaries. Now again, every situation is going to be different. If Jane wanted a larger estate, we could have made changes to where cash flow was coming from, but this is what Jane wanted in her specific scenario.
Now you know exactly what somebody age 60 with $900,000 in savings can precisely spend in retirement and the thought process behind it. You now have what you need to go and apply this thought process to your own life to find out what works best for you. However, I want you to remember that every situation is going to be different. So there may be some tiny roadblocks or things that get in the way that will likely come up in your situation that we weren't able to address in this video today. So if you want a team of experts to help analyze your situation and help you understand if you are ready to retire, then click the link in the description below. This will take you to a page where you're able to schedule a completely free call with a member of our team. We will help you begin to take the next step in securing your financial future.